It's been another quiet calendar week, but there's still plenty of market-moving events for my next guest to discuss. Valentin Marinov of Citi joins me on the phone now for this weekly wrap-up interview. Valentin, welcome. Let's begin. China's mixed bag of data has continued this week as official PMI figures were reported at an 8-month low. Combined with weak investment, these indicators have been countered by optimistic exports and bank lending. What conclusions, if any, are we able to draw regarding the economy's direction? And does this explain the Chinese currency's present weakness?
Investors are attributing the latest yuan depreciation to officials' desire to broaden the trading band of the currency. Citi is expecting the PBOC to double the trading band from 1% at present to 2% going forward. What is not entirely clear is whether the introduction of two-way FX risks by the PBOC is driven by concerns about China's growth prospects. On March 5th, the Chinese Communist Party will be holding its regular Congress, and there is the risk that they may signal willingness to sacrifice their current 7.5% growth target as they push for more reforms in the world's second largest economy. If this is combined with potential disappointment from the official PMI due tomorrow and the HSBC PMIs due on Monday, all that may add to the downside pressure on China yuan in coming weeks.
Moving on to an ever-changing story. As Ukraine tells the EU it needs an immediate infusion of $4 billion to help stabilize the economy, some are asking, could Ukraine be the new Egypt? What could the economic ramifications be should a similar social, political, economical cycle come into fruition here?
Citi's view is that the conditions in Ukraine should eventually stabilize, and we do not expect the Ukrainian unrest to spread across the border really to its neighbors, Belarus and indeed Russia. In this respect, Ukraine need not become the new Egypt, as you said. We also do not see the recent tensions between Ukraine and Russia escalating into a military conflict. If anything, Russia may continue to play an important role in any future sustainable resolution of the uncertainty plaguing the Ukrainian economy in the moment.
Despite British Prime Minister David Cameron's attempts to woo German Chancellor Angela Merkel into heeding Britain's wishes for EU reform, the Prime Minister was left disappointed as Ms Merkel instead offered a limited package with a focus on keeping Europe together. Is a stronger EU suggestive of a stronger euro?
Chancellor Merkel did extol the virtues of a closer European Union, and that may be a factor for deeper economic integration, stronger growth, and indeed stronger euro. The comments could be supportive for sterling as well if they alleviate some concerns in the run-up to the Scottish independence referendum on September 18th. All that said, Merkel's visit may well leave Britain going down the path of EU referendum in 2017. Such a referendum may keep investor concern about the integrity of the European Union very much alive. While we expect the UK to remain an integral part of the European Union, some concerns may linger, and as a result, all that may remain an important downside risk for both euro and sterling.
And lastly, Valentin, Janet Yellen repeated once again yesterday that the Fed is likely to keep trimming asset purchases. Did this help or hinder the US dollar in market response? And how does this bode for trader anticipation in the lead up to next week's US calendar events?
The dollar weakened against most majors in the wake of Yellen's congressional testimony yesterday. Investors focused on her remark that further significant deterioration in the U.S. growth outlook could lead to the Fed adjusting the speed of its tapering program. One could call this even the Yellen put, if you wish, that is helping boost market risk sentiment and support risk-correlated assets and currencies. If the U.S. data continues to disappoint in coming days, it could be seen as increasing the chances of less aggressive taper from here and should ultimately weigh on the dollar against majors like the euro, sterling, but also yen and to a degree the Swiss franc. To the extent that weaker U.S. data also weighs on market risk sentiment, the dollar may be more resilient against risk-correlated currencies like Aussie and CAD. At the same time, better than expected data in coming days could help the dollar across the board.
Valentin, a pleasure always to receive your thoughts. Thank you very much. Well, that's all from me for this trading week, but do stay tuned as Ben Jones will be back shortly with a closer look at that European inflation data. From me though, it's goodbye for now.